Okay, let's be honest. Have you ever felt like
Yeah.
the whole world of investing is speaking like a secret language you just don't understand?
Yeah.
You know,
Right.
between 401ks and Roth IRAs, stocks and bonds,
Yeah.
it's easy to feel lost.
Yeah, it can be very confusing.
You're not alone.
Definitely not.
And that's why we're
That's why we're here.
diving deep into the world of
Yes.
investment plans today.
Investment plans, exactly.
You've sent us a ton of resources, articles,
Yes.
sample plans,
Yeah.
the whole shebang. And we're here to help you decode it all.
Break it down.
Yeah.
It's fascinating how many people just avoid creating a plan,
Really?
even though it can make a huge difference.
Right.
It's like setting off on a road trip with no map or destination.
Oh, I
You
see.
know what I mean?
That's a good point.
Yeah.
No, definitely a good point. So we're going to map out a clear route for you. We'll break down why a plan is essential, what it actually looks like, and even tackle some common misconceptions along the way.
We'll debunk those myths.
Yeah, sounds good.
One big myth is that investment plans are only for the super rich.
Oh, yeah.
But in reality, a well-crafted plan can be the key to achieving any financial goal, no matter your income.
Makes sense.
Yeah.
So true. And the first step to building that plan is understanding why it's so important in the first place. I mean, it's not just about having a fancy document to show off.
No, not at all. It's about aligning your finances with your life goals.
Hmm.
Think about it.
Okay.
Whether you're dreaming of early retirement, buying a house, or simply having enough to cover those unexpected life curveballs, an investment plan acts as your financial GPS.
Oh, I love that analogy.
I,
But so many people I know,
yeah.
they set these like vague goals.
Mhm.
Like, I want to be financially secure.
Yes.
How do we go from those fuzzy ideas to a concrete plan?
That's where SMART goals come in.
Okay.
We've all heard the acronym.
Yeah, we have.
But it's surprising how many people miss the mark.
I see. Yeah.
A lot of times people set goals that are too broad, like save more money.
Right.
Yeah.
Okay. So how do we make them smarter?
Well, let's say you're aiming for early retirement.
Okay.
Instead of just saying retire early,
Yeah.
a SMART goal would be, I want to retire at 55 with enough savings to maintain my current lifestyle.
Check.
That's specific, measurable, achievable, relevant to your life, and time-bound.
Yeah.
Makes sense.
It suddenly feels a lot more tangible, doesn't it?
It should, yeah.
So we've got our destination in mind,
Hmm.
but how do we even know where to begin?
That's where things get interesting.
Okay.
We need to take a look at your current financial landscape.
Okay.
And just like a doctor needs a complete medical history to make a diagnosis,
Yeah.
we need a full financial picture to create an effective plan.
I get it.
Right.
So we're talking income, expenses,
Yes,
assets like savings accounts,
exactly.
and any debts you might have.
Precisely. It can feel a bit like a financial confessional at first. But trust me, being brutally honest with yourself here is key.
Yeah.
There are even apps that can
Oh.
connect to your accounts and give you a clear view of your spending habits.
Wow.
Yeah.
I guess ignorance isn't bliss when it comes to your finances.
No, not really.
Okay, let's say we've done our financial inventory. What's the next step in this investment journey?
Well, we need to figure out your risk tolerance.
Oh, okay.
It's not a one-size-fits-all approach.
Got it.
Some people are comfortable bungee jumping off a bridge, while others get nervous riding a Ferris wheel.
Wow.
Investing is similar,
Right.
you know?
That's a great way to put it.
Yeah.
I always felt a little lost when people talk about risk.
Yeah.
How do I actually figure out how much risk I'm comfortable with?
There are a few key things to consider. Your age is a big one.
Yeah.
A younger investor with a longer time horizon might be more comfortable with riskier assets like growth stocks.
Mm-hmm.
They have more time to recover from market dips. But someone closer to retirement may prioritize preserving their capital and choose more conservative investments.
Oh, okay.
Okay.
So it's not just about personality. Your life stage plays a big role too.
Absolutely. And don't forget about your financial goals.
Right.
Are you investing for a retirement, a down payment on a house, or something else entirely?
Yeah, good point. Okay, so we've got our goals, our financial snapshot, and we're starting to understand our risk tolerance. It feels like we're getting closer to building this plan.
We are.
What comes next?
Now we need to consider your time horizon.
Time horizon.
Simply put, it's the length of time you plan to invest before you'll need to access the money.
Oh, I see.
Right.
So if I'm investing for retirement in 30 years, that's a long time horizon.
Exactly. And that longer time frame allows you to ride out the ups and downs of the market.
Yeah.
You're not as worried about short-term fluctuations because historically, the stock market has tended to trend upwards over the long term.
I see.
Does that make sense?
Yeah, that makes sense. But what if I need the money sooner? Say, in 5 years for a down payment on a house.
Then a shorter time horizon demands a different approach.
Okay.
You might choose more conservative investments like bonds to minimize the risk of losing money right when you need it.
Got it.
You see?
That makes a lot of sense. So time horizon and risk tolerance are kind of intertwined, aren't they?
They are. They're definitely connected.
Okay.
It's all about finding that sweet spot between maximizing returns and managing risk based on your individual needs and goals.
Right. Okay. I'm starting to see how all these pieces are coming together.
Good.
We've talked about goals, our current financial situation, risk, and time horizon. What's the next layer of this investment plan puzzle?
This is where we get into the strategy of spreading your investments across different asset classes, which is called asset allocation. You've probably heard the saying, don't put all your eggs in one basket, right?
Yeah, classic advice.
And it applies perfectly to investing. Instead of putting all your money into one type of investment, like just stocks, you diversify your portfolio by investing in a mix of assets, like stocks, bonds, and even real estate.
So we're basically creating a safety net to cushion the blow if one area of the market takes a dip.
You got it.
Oh, okay. And the way you divide your investments depends on your risk tolerance and time horizon?
Makes sense. Is there a specific ratio that people usually start with?
A common starting point is the 60-40 portfolio,
Okay.
which is 60% stocks and 40% bonds.
Got it.
But just like everything else in investment planning,
Yeah.
this is a starting point and can be adjusted based on your specific situation.
Right. Makes sense. Okay, so we're diversifying our portfolio, spreading the risk. Now what? Do we just pick some random investments and hope for the best?
Not quite. We need to choose specific investment vehicles,
Yeah.
the actual products we use to invest.
Right.
That's where mutual funds, ETFs, individual stocks, and bonds all come into play.
Whoa, that sounds like a whole new layer of complexity.
It can be, but
It's a lot to take in.
we'll make it easy to understand.
Okay, good.
Don't worry, we'll break it all down for you. And to make things even clearer, we're going to dive into a real-life example in the next segment.
Oh, that's great.
Yeah.
I'm excited to see how all these pieces fit together in a practical way.
Get ready to see an investment plan come to life.
Sounds good. All right, we've laid the groundwork understanding the why and the what of investment plans. Now, let's dive into the how.
Okay.
We've got a real-world example from the material you sent.
Yes.
Someone just like you, figuring out this whole investment thing.
It's amazing how a concrete example can make all these concepts click, isn't it?
Yeah, for sure.
It's like going from reading a cookbook to actually tasting the dish.
Exactly.
Right.
So in this case, we're looking at someone in their early 30s who's aiming for a comfortable retirement at 65.
Mm-hmm.
Sounds pretty relatable, right?
Very much so.
And their goal is to build a nest egg of $1.5 million.
That's the goal.
Now, that might sound like a huge number.
But remember, they have time on their side.
Exactly.
They're starting with $30,000 in savings, earning $80,000 a year.
Okay.
And their monthly expenses are around $4,000.
Right.
We also know they have a moderate risk tolerance.
Which means they're not afraid of a little volatility,
Yeah.
but still want to protect their investments
Makes sense.
based on their risk-tolerant time horizon and that ambitious goal.
Mm-hmm.
The example suggests a 60-40 asset allocation.
Okay, what's that?
60% stocks for growth potential and 40% bonds for stability.
Got it. So that makes sense.
Yeah.
But how do they actually put that allocation into practice?
Right.
Where do those investments actually go?
This is where choosing the right investment vehicles comes in.
Okay.
Think of them as the containers for your investments.
Okay, like different size boxes, each holding a piece of the portfolio.
Exactly.
Okay.
And this example utilizes a combination of retirement accounts like a 401k and a Roth IRA,
Okay.
along with a diversified portfolio of investments held in a regular brokerage account.
So they're spreading their investments across different accounts as well.
That's right. They're taking advantage of tax-advantaged retirement accounts,
Oh,
like
okay.
their 401k, especially if their employer offers any matching contributions.
Like free money.
Free money, yeah.
Who doesn't love free money?
Right.
And what about the Roth IRA?
The Roth IRA is great because although you contribute after-tax dollars, your money grows tax-free, and you won't owe any taxes when you withdraw in retirement.
So no taxes later.
It's a powerful tool, especially for younger investors who anticipate being in a higher tax bracket later in life.
Oh, that's a really clever strategy. But with all these different accounts and investment options, it can feel a little overwhelming.
I can understand that.
Where do you even start?
One approach is to start simple with low-cost index funds.
Index funds, okay.
They offer instant diversification by tracking a specific market index, like the S&P 500.
So instead of trying to pick individual stocks, which can be risky and time-consuming, you're essentially buying a small piece of hundreds of companies at once.
That's right. A great way to gain broad market exposure without having to become a stock-picking expert.
Okay, so we've got index funds covered. What other types of investments might be included in this example plan?
Well, diversification is key, remember. So in addition to those broad market index funds, they might add some specialized funds.
Okay.
Focusing on specific sectors like technology or healthcare.
Like if they're really into renewable energy?
Exactly. They could invest in a clean energy ETF.
That's interesting.
It allows them to tailor a portion of their portfolio to specific interests or areas they believe will outperform the overall market.
So it's like a puzzle where all the pieces are fitting together.
Yeah.
But what happens once the plan is in place?
Right.
Do you just sit back and let it run on autopilot?
That's a common misconception.
Right.
A well-crafted plan isn't a set-it-and-forget-it deal.
What?
It's more like tending a garden.
Oh, okay.
You need to water it, weed it, and make adjustments as things grow and change.
So what does that tending actually look like in the context of investing?
It involves staying informed about market trends, monitoring your portfolio's performance, and most importantly, rebalancing regularly.
Rebalancing. That sounds kind of like rearranging furniture.
It's about maintaining your desired asset allocation.
Okay.
Remember that 60-40 split we talked about?
Yeah.
Well, as certain investments perform better or worse than others, the percentages can drift,
Oh, I see.
throwing your portfolio out of balance.
So like if stocks have a great year, their value shoots up, your portfolio might suddenly become 70% stocks and 30% bonds.
Exactly. And that means you're now taking on more risk than you intended.
Right.
Rebalancing involves selling some of those high-performing assets and buying more of the underperforming ones to bring the portfolio back to your target allocation.
Makes sense. It's like making sure your ship stays on course even when the winds change.
That's a good way to put it.
But how often do you actually need to rebalance?
It depends on various factors. But a good rule of thumb is to review your portfolio at least once a year.
Okay.
Or even more frequently if you're experiencing significant market fluctuations.
I'm starting to see why having a clear plan is so important.
Yes.
It provides a roadmap, helps you make informed decisions, and even guides those course corrections along the way.
And don't forget, a good plan also includes an action plan.
An action plan.
Specific steps to take to ensure you're on track to reach your goals.
So it's not just about the big picture. It's about the day-to-day actions that get you there.
Precisely.
So in this example, the action plan involves contributing regularly to those retirement accounts we talked about.
Yes.
Ideally, taking advantage of any employer matching contributions
Right.
and making sure their investment choices are aligned with their risk tolerance and time horizon.
That's right.
So for our 30-year-old aiming for retirement, consistently investing a portion of each paycheck is key.
It's crucial. Even small, regular contributions can grow significantly over time thanks to the power of compounding.
Compounding. I love how one of the most powerful forces in investing is also one of the simplest to understand. It's like watching a snowball roll downhill and gather more snow as it goes.
It's a beautiful thing to witness, especially when it's your money doing the growing.
Exactly.
And a well-structured investment plan helps ensure you're making the most of that compounding effect.
Now, while this example focuses on retirement planning, which is a common goal,
Right?
there are actually different types of investment plans tailored to various financial objectives.
Absolutely. It's not a one-size-fits-all approach.
Right.
You mentioned different containers for your investments earlier. Think of types of investment plans as different trucks carrying those containers.
Okay, a fleet of trucks, each with a specific purpose.
Exactly. And the type of truck you choose depends on your cargo, or in this case, your financial goals.
Oh, I see.
So let's explore some of these different investment plan trucks in the next segment.
I'm ready to hit the road and see where these different investment journeys can take us. So we've got our investment containers and our metaphorical trucks to transport them.
Right.
What exactly are these different investment trucks,
Okay.
or rather types of investment plans?
Think of them as specialized vehicles designed for different financial journeys.
Okay.
One of the most common is, of course, the retirement plan.
Yeah.
Which we've already touched on.
That's the one that usually comes to mind first.
Yeah.
What are some of the other trucks in this fleet?
Well, let's say you're saving for a child's education.
Okay.
That's where an education investment plan comes in.
Okay.
It's specifically designed to help you accumulate funds for those ever-increasing tuition costs.
I've heard about 529 plans and Coverdell ESAs.
Mm-hmm.
Are those considered types of education investment plans?
They are.
Okay.
A 529 plan offers tax advantages and flexibility,
Okay.
allowing you to use the funds for a variety of qualified education expenses, not just college.
So it could even be used for private elementary school or vocational training.
Exactly.
Wow, that's interesting. What about those who are focused on building wealth, like beyond just retirement savings?
That's where a wealth accumulation plan comes into play.
Yeah.
It's all about strategically growing your assets over the long term.
Right.
These plans often involve a more aggressive investment approach,
Okay.
taking advantage of growth opportunities in the market.
So someone using this type of plan might have a higher risk tolerance and a longer time horizon.
Exactly.
Okay.
They might be more comfortable with investments like growth stocks or real estate,
Right.
which have the potential for higher returns but also come with greater volatility.
Right. Okay, I'm starting to see the distinctions between these different plans.
Yeah.
Is there a specific type for generating income, especially helpful for those nearing retirement?
You're thinking of income generation plans.
Yeah.
These plans prioritize investments that provide a steady stream of income, such as dividend-paying stocks, bonds, or even real estate rentals.
That makes sense. It's like creating your own personal pension plan.
You could say that.
We've covered retirement, education, wealth accumulation, and income generation.
Right.
Is there a truck for those unexpected bumps in the road?
Absolutely. You're thinking of emergency fund plans.
Yeah.
These aren't about growing wealth,
Right.
but about creating a safety net for those unforeseen expenses that inevitably pop up in life.
So if your car breaks down or your roof starts leaking or you face a sudden job loss, you've got a cushion to fall back on.
Exactly. It's about peace of mind, knowing you have a readily accessible reserve
Right.
to cover those unexpected costs without derailing your other financial goals.
They've really covered a lot of ground in this deep dive.
We have.
It's amazing how understanding the different types of investment plans clarifies the whole landscape.
It's like having a toolbox with different tools for different jobs. You wouldn't use a hammer to tighten a screw, right?
Right, yeah.
Similarly, choosing the right investment plan for your specific goals is crucial.
So where do we go from here?
Well,
We've learned so much about these different investment trucks and the containers they carry.
yeah.
How do we actually start putting these concepts into action?
Well, the first step is identifying your most pressing financial goals.
Okay.
What's most important to you right now? Is it saving for retirement, paying down debt, or building an emergency fund?
Once you've got a clear picture of your priorities,
Yeah,
you can choose the investment plan truck that's best suited to transport you to your destination.
exactly. And remember, it's not a one-time decision.
Right.
Your goals and circumstances might evolve over time.
Yeah.
So revisiting and adjusting your plan is key to staying on track.
It's like checking your GPS periodically to make sure you're still headed in the right direction, even if there are a few detours along the way.
That's a great analogy.
And as you navigate this journey, remember to stay informed, seek guidance when needed, and most importantly, never stop learning. It's been an incredible journey exploring the world of investment plans with you.
It has been.
I think I finally speak the language.
Yeah,
And hopefully our listeners feel empowered to start building their own financial roadmaps.
I hope so too. Remember, the most important step is the first one.
You got it.
Even a small action taken today can pave the way for a brighter financial future.
Right.
So what will your first step be?